Hi, and thanks for tuning in. My name is Sean Bjork, and our role is to serve as the independent investment fiduciary advisor for your organization's workplace retirement savings program. Thanks for joining us for this fourth quarter Student of the Market. We're going to look at what the markets have done through December, so almost year end here. We're going to do something a little bit different this time. We're going to do 4 slides in 5 minutes, just the greatest hits. And as always, the goal for this series is to help inform the important financial decisions you're making in your workplace retirement savings program and beyond. So with that, let's do this. Looking at bond investors, let's kick it off with on the fixed income side. And if you'll recall, we talked earlier in the year how the stretch from May to October in almost 100 years of investing was the worst period for bond investors. And as is often the case in the markets, when almost everybody had thrown in the towel, sure enough, bonds had a huge November, rebounding in a big way, and having been historically the 8th best month in bond investing history going back to 1926 and the Great Depression. That 4.5% return puts you in pretty rarefied air. What's interesting here is if we look at the right-hand side of the chart and we look at where bond markets historically were a year later after these historically great months, on average, it's worked out pretty darn well for bond investors. So interesting to see if history repeats itself and something to keep an eye on. So speaking of November in this historical run for bonds, what if we add stocks to the equation and we look at a balanced 60-40 traditional portfolio? So if we take a peek here, we can see that sure enough, it was bonds and stocks that were up in a big way in November. Over 9% for stocks, 4.5% for bonds. If we go back to 1950, this puts us in the top 15. Not quite as rarefied air as on the bond side, but certainly a welcome turn for investors in a more traditional balanced 60-40 portfolio. So, looking at the markets, we see, a great November for investors. What happens when we look at the behavioral side of things, or the behavioral component, and we look at flows, right? And what investors are doing with their money. And so, if we look at the outflows specifically in mutual fund and stock funds year to date, we can see that we're something to the tune of about $100 billion flowing out of stock and bond ETFs funds year to date, which is hard to believe given we're up almost 20%. But what's interesting here is if we look at what tends to happen historically the next year after these big outflows, we can see that oftentimes when the herd zigs, maybe it's better to zag, right? And so, being a contrarian when it comes to flows historically has served investors well, and it'll be interesting to see how that plays out this time. Finally, and to close out, let's talk about the election year. So a lot of political silliness is likely to come our way in the coming year. What does that mean for the markets? Well, frankly, not a ton, right? But what's interesting is, there's a bit of a misconception out there that election years are bad for the markets. That would be true for midterm election years. You see that the average return for a midterm election year is 7.4% versus the historical, average year of 10.2%. Presidential election years tend to be modestly better than average. So just something to keep in mind, that even though there's going to be a lot of political noise coming our way in the relatively near future, the market tends to not be affected by that in terms of a long-term trajectory. So just something to keep in mind, and again, interesting to see how it'll play out in the coming year relative to history. So with that, that's it, right? Just the greatest hits edition. Please do let us know if you like this abridged version versus the full nerd edition that we were doing previously. Thanks so much for tuning in. We're going to put some important disclosures on the screen. While we do, we're going to wish you a great year end. Thank you for continuing to tune in and invest the time to become a better student of the market with us. So with that, thank you very much for your time. Appreciate it, and we'll see you next time. So long.